Why is it that the very wealthy can buy a real estate year one and have infinite returns, meaning zero cash in the deal left, using tax system to help them? And why is it that they can do this? In this video, I'm gonna break it down exactly how they buy and leverage their tax savings to get infinite returns on their deal. I am not your CPA, but I am a CPA for the very wealthy. My name is Jacqueline Matoza. I've worked with Fortune 25 and CEOs and CFOs of Fortune 25 companies. So here we've got a buyer. We'll call him my billionaire buyer. And he's looking at a storage building. The storage building has a sales price of 1 million, net operating income of 80 grand. That gives you a cap rate of 8%. So typical loan. He called his bank. His blender said, hey, I'm gonna give you two types of loans, a 90% loan and an 80% loan. And he's gonna run the numbers to try to get himself infinite returns based on tax savings alone. So he calls the bank's gonna give him 90% and 80%. So the bank is gonna loan money into the escrow. He's gonna loan his down payment, the difference, 10% or 20%. And we're gonna run the numbers and show you how some numbers foot and some don't. Okay, so here, let's start with the 10% down example. 10% down on $1 million is 100,000. That alone, we're gonna leave it there. He called his accountant. His accountant said, hey, billionaire, your cost seg is gonna be about 35%. So he's like, okay, cool, 35% of $1 million, that's $350,000. So this is his above the line tax depreciation number. So in order to understand how much taxes he's gonna save on buying this building at an 8 cap rate, that's a pretty solid cap rate for storage. So here he's gonna say, okay, what's my federal tax rate, the highest bracket I'm trying to reduce? Here we're gonna use the example 37%. So here, the 37% times 350 is 129,000.5K. Multiply his state rate of 5% times 350, that's 17.5K. So total taxes saved here is going to be adding the 129.5 and the 17.5. This is gonna get him $147,000 saved. This $147,000 here on his taxes saved is less than the down payment here. So when we're looking at these two numbers, he has an excess deduction of 47K to offset other active income because he's got a real estate business. So here, he can take that and offset other income with this. So this is one of the ways that you would buy. You wouldn't even need to go into your cash flow, your net operating income, because here at closing, he's already netting 47,000 extra cash savings than what he's putting down. So using the 10% down loan, he's like, this is great, we can do it. This pencils with an immediate on closing cash back in my pocket savings of tax money. So he can close this in December, then he files his tax returns in February, March, and he can get this all done. So now if you look at the 20% down, 20% of $1 million, he has to come up with 200K. So now copying all these things are not gonna change depending on the loan amount. These are just building numbers. So he's gonna have the 147,000 savings from cost seg in his taxes. This number doesn't change. So here, there's a gap. So we're gonna have to go into his net operating cash flow. The difference here is going to be about 8 months worth of cash flow because you've got 200 minus 147, that's 53K. Here's 80 grand, so you're roughly, a couple months in. So the 53K is going to plug here, and he is now then between all three going to net to zero. But now it's not an immediate infinite return at acquisition. He has to wait about 8 months to get that 53 grand back. So he's gonna say, nope, I don't want the 20% down because I don't have infinite returns. If your net operating can carry the 90% debt load on the interest rate, then you're gonna run this through. We're assuming here his net operating doesn't change. It obviously would, but we're using this for simple fact patterns. So here, his 80 grand covers this little cushion. So here you still have an 8-month cash on cash, which is great. Don't get me wrong, but that's not what one of my old clients from Fortune 25 executive days, when they have family offices investing their money, they would have absolutely said, we want the 90% loan and we're gonna pencil it out, and as long as your net operating loss and all of this pencils, it doesn't matter as long as it's cash flowing and you don't have a net operating loss. You want net operating income here, and it's an infinite return with cash flow. That doesn't really matter as long as you can make upgrades and you have a way to improve the building and improve the DSCR, they're gonna make money on it. So if you are a real estate professional that buys real estate like this and wants to learn how to do infinite returns leveraging tax savings and buying properly, and you make over $250,000, click the link below and book a call to talk to me, and we can do this for you.